If you've spent any time watching credit score videos online, you've probably heard the same advice repeated over and over again. Always keep your credit utilization under 10%. People say it like it is some magical secret that instantly unlocks an 800 credit score. Some people become so obsessed with this number that they stop using their credit cards completely, panic every time their balance goes up, and even make multiple payments every single week just to make sure their utilization never crosses that so-called safe zone. But what if I told you that this advice is one of the most misunderstood credit myths on the internet? What if constantly stressing over staying under 10% is actually hurting your financial habits more than helping your credit score? Because the truth is, the credit system is far more flexible than most people realize. And many of the so-called rules being pushed online are missing important context. In reality, millions of people with excellent credit scores regularly go above 10% utilization, and some of them still qualify for premium credit cards, low-interest loans, and even mortgages without any problems. Yet social media has created this fear that if your utilization touches 20%, 30%, or even higher for a short period of time, your financial life is somehow ruined. That fear has made people treat credit cards like dangerous traps instead of powerful financial tools. And here's the crazy part. Most people who obsess over utilization don't even fully understand how it works. They think utilization permanently damages their score, but that's not true in most cases. They think carrying a small balance helps build credit, but that's another major misconception. They believe the lower the utilization, the better your entire financial profile becomes, even if they are financially stressed, avoiding necessary purchases, or constantly worried about a number that changes every month anyway. The reality is that credit scores were designed to measure risk, not perfection. Banks want to see responsible behavior over time, not someone terrified to use their own credit cards. In fact, some people hurt their relationship with lenders by barely using their available credit at all. So in this video, we're going to completely break down the truth about credit utilization, where the under 10% myth came from, why it became so popular online, when low utilization actually matters, and what smart credit users really focus on instead. I'll show you why temporary high utilization is usually not the disaster people think it is, why paying interest is a much bigger problem than utilization fluctuations, and how you can stop obsessing over tiny percentages and start building credit in a healthier, smarter, and more realistic way. Because once you understand how utilization truly works, you'll stop living in fear of your credit cards and start using them the way financially successful people actually do. The entire keep your utilization under 10% idea didn't appear out of nowhere. It started as a general recommendation because lower utilization can help your credit score. Over time, though, people on social media turned that recommendation into a hard rule. Almost like crossing 10% instantly destroys your financial future. That's simply not true. Credit scoring models are far more complex than one single percentage. Yes, utilization matters, but there's no magical line where 9% is perfect and 11% is suddenly terrible. The internet simplified a complicated system into a catchy number because it sounds easy to remember. And once people started seeing temporary score boosts from lowering balances, the myth spread everywhere. But what many creators don't explain is that people with excellent credit scores often report utilization above 10% regularly. Some stay around 15%, 20%, or even higher depending on spending patterns, and they still qualify for premium credit cards and loans. Your payment history, account age, income, stability, and overall debt management also matter. The problem is that many people became obsessed with chasing perfection instead of understanding how the system actually works. A guideline became a fear-based rule, and now millions of people are stressing over numbers that were never meant to be treated like absolute laws in the first place. One of the biggest problems with the under 10% obsession is that people start avoiding normal credit card usage completely. They become afraid to spend money, even when they can afford to pay it back responsibly. Some people stop using their cards for everyday purchases because they think any balance is dangerous. But lenders don't just want to see low balances, they also want to see responsible activity. Banks make decisions based on patterns. If someone never uses their available credit, lenders may not see enough activity to justify higher credit limits or stronger trust. Think about it from the bank's perspective. If two people both pay on time, but one actively uses credit responsibly while the other barely touches their cards, the active user often appears more valuable as a customer. Credit cards were designed to be used, not hidden away forever. Responsible usage, followed by on-time payments, shows financial control. Some people even hurt themselves by constantly paying off purchases before the statement closes because they want to force ultra-low utilization every month. This creates unnecessary stress and confusion. The smarter approach is simple. Use your credit naturally, stay within your budget, and pay your balance on time. Credit building is about consistency and responsibility, not fear. The goal should never be avoiding credit completely. The goal should be learning how to manage it intelligently over the long term. Here's one of the most important truths about credit utilization that almost nobody explains properly. Utilization usually has no memory. That means most major credit scoring systems only care about the most recently reported balances. If your utilization goes high one month but drops the next month, your score can recover very quickly. Yet people online act like temporarily crossing 30% utilization causes permanent damage, which creates unnecessary panic. Imagine someone spends more during the holiday season, books, travel, buys gifts, or handles an emergency expense using their credit card. Their utilization might spike temporarily, and yes, their score could drop for a short time. But once they pay those balances down, the score often rebounds within the next reporting cycle. That's because utilization is dynamic. It changes constantly based on your reported balances. This is why stressing over every small fluctuation is unhealthy. Life happens. Some months, you spend more than others. That doesn't automatically make you financially irresponsible. What matters more is whether you eventually pay the balance responsibly. Now, this doesn't mean maxing out cards is a good idea all the time, but it does mean you shouldn't live in fear of temporary utilization increases. Credit scores move up and down naturally. Understanding that flexibility can completely change the way you think about credit cards and remove a huge amount of unnecessary financial anxiety from your life. The obsession with staying under 10% has created some extremely unhealthy financial habits. People are constantly checking their credit score apps, panicking over small balance increases, and making multiple payments every single week just to keep utilization artificially low. Some even avoid necessary purchases because they're afraid their score might temporarily dip by a few points. That level of stress is not financial freedom, it's financial anxiety disguised as responsibility. Your credit score should be a tool that supports your life, not something controlling your daily decisions. Many people have become so focused on optimizing their score that they forget the real purpose of good financial management: stability, savings, and long-term wealth. A person with a strong emergency fund, no late payments, and healthy spending habits is in a much better financial position than someone obsessing over utilization while living paycheck to paycheck. Credit scores are important, but they are not everything. Some people sacrifice convenience, peace of mind, and even personal enjoyment just to maintain a perfect utilization percentage. That's not sustainable. The smarter mindset is balance. Use credit responsibly, avoid overspending, and understand that small fluctuations are normal. A temporary score drop does not define your financial future. Real financial success comes from smart habits, not from treating every percentage point like a life or death situation. One of the biggest misunderstandings in the credit world is the difference between carrying a balance and allowing a balance to report. Many people think they need to carry debt month after month to build credit, but that's completely false. Carrying a balance simply means you didn't pay your full statement balance and now you're being charged interest. That does not help your credit score in some magical way. In reality, paying interest is one of the fastest ways to lose money unnecessarily. What actually matters is making your payments on time and managing your accounts responsibly. You can let a normal statement balance report and still pay it in full before the due date without paying any interest at all. That's the ideal situation. Unfortunately, many people focus so much on keeping utilization ultra low that they ignore the much bigger financial danger: high interest debt. Someone with 20% utilization who pays their balance in full every month is often in a stronger financial position than someone with 5% utilization who carries debt and pays interest constantly. Banks profit when people carry balances. Financially smart people avoid unnecessary interest whenever possible. The real goal should not be achieving a perfect utilization number. The real goal should be using credit in a way that protects your money, avoids debt traps, and builds long-term financial stability over time. Now, to be fair, there are situations where lowering your utilization temporarily can absolutely help. This is where the internet advice becomes partially true. If you're preparing to apply for a mortgage, auto loan, apartment, or premium credit card, Lowering your utilization before the application can improve your score and make you appear less risky to lenders. This is called optimization. The key difference is that smart people use low utilization strategically, not obsessively every single month forever. Think of it like preparing for an important event. You optimize your finances before major applications because you want your credit profile looking as strong as possible at that specific moment. But outside of those situations, normal utilization fluctuations are usually not a huge issue. Unfortunately, social media turned a temporary strategy into a permanent lifestyle rule. People started believing they must always stay under 10%, no matter what. That's unrealistic for many normal consumers who use credit cards for travel, business expenses, emergencies, or large purchases. Responsible credit use does not mean never using your available credit. It means understanding timing and planning strategically when necessary. If you know a major loan application is coming soon, lowering balances beforehand makes sense. But outside those important moments, constantly stressing over tiny utilization changes is usually unnecessary and often creates more anxiety than actual financial benefit. So what do financially smart credit users actually focus on? They focus on behavior, not obsession. They use their credit cards normally for expenses they can already afford. They stay within their monthly budget, and they consistently pay on time. That's the real foundation of strong credit. Instead of panicking over utilization every few days, they think long-term. They understand that payment history matters heavily, and they know responsible habits repeated over years create stronger results than chasing perfection every single month. Smart users also work on increasing their total available credit over time. As their income and credit profile improve, they request credit limit increases or open better accounts strategically. This naturally lowers utilization without forcing unhealthy spending restrictions. For example, spending $2,000 on a card with a $20,000 limit looks very different than spending $2,000 on a card with a $4,000 limit. Higher limits create more flexibility. But again, the goal isn't to spend recklessly. The goal is controlled usage with financial discipline. Smart credit users also prioritize savings, emergency funds, and avoiding unnecessary debt. They understand that a high credit score is useful, but it's only one part of overall financial health. Real financial success comes from managing money wisely, not from obsessively refreshing your credit score app every time your utilization changes by a few percentage points. At the end of the day, one of the biggest mistakes people make is turning their credit score into their entire financial identity. Social media has convinced many people that a perfect score automatically means financial success, but that's not true at all. You can have an excellent credit score and still struggle financially if you have no savings, no investments, and constant financial stress. A credit score is simply a tool lenders use to measure risk. It's not a measure of happiness, wealth, intelligence, or financial freedom. Yet so many people spend hours obsessing over tiny score changes while ignoring bigger financial priorities that matter far more in real life. Building emergency savings, increasing income, avoiding high-interest debt, and investing consistently will usually improve your life more than squeezing utilization from 12% down to 2%. The healthiest mindset is understanding that credit should support your financial goals, not control your emotions. Use your cards responsibly, pay your bills on time, and stop treating temporary utilization changes like financial disasters. Most importantly, remember this: your bank account matters more than your credit score. Screenshot: a strong financial life is built through stability, discipline, and smart decisions over time, not through fear-based obsession over one percentage number that changes every single month anyway. So, at the end of the day, here's the truth that most people never hear when it comes to credit utilization. You do not need to live in fear of your credit cards to have a great credit score. The internet turned one small guideline into a massive obsession, and now millions of people are stressing over staying under 10% like it's some life-changing secret. But real financial success is much bigger than one percentage number. Yes, utilization matters, but it's only one part of the entire picture. What matters more is how consistently you manage your money over time. Are you paying on time? Are you avoiding unnecessary debt? Are you building savings? Are you using credit responsibly instead of emotionally? Those are the habits that actually create long-term financial stability. And remember this: temporary utilization spikes are not permanent disasters. Your score can recover. Your finances can improve. Credit is flexible when you use it intelligently. So stop obsessing over perfection and start focusing on smart financial behavior instead. Use your cards naturally, stay within your budget, pay your balances responsibly, and stop letting fear control every financial decision you make. Because financially successful people don't panic every time their utilization changes. They understand how the system works and use it to their advantage. If this video changed the way you think about credit utilization, make sure you hit the like button and subscribe because we're re-exposing the biggest credit myths that nobody else explains properly. And before you go, let me know in the comments, what credit myth did you believe for years before watching this video? I really want to hear your experiences. Thanks for watching, and I'll see you in the next video.